Too easy to qualify for unsecured credit lines exposed. What is a line of credit? A line of credit is a lending arrangement between a financial institution like a bank and a business. A credit account is extended to the borrower. It has a maximum credit limit to borrow against. The money does not have to be used for a pre-specified purchase. It's a bit like a credit card without the plastic. What's the difference between secured and unsecured lines of credit? With secured lines of credit, the credit grantor has established a lien against an asset belonging to the borrower. This asset becomes collateral. It can be seized or liquidated by the lender in the event of default. And with unsecured lines of credit, no asset acts as collateral. The lender assumes a much larger risk, and none of the borrower's major assets can be seized if they default. Here are some of the advantages of credit lines. Credit lines provide unique advantages to borrowers, including flexibility. Borrowers can use their line of credit and only pay interest on what they use, unlike loans where they pay interest on the full amount borrowed. Credit lines can be reused. As you acquire a balance and pay the balance off, you can use that available credit again and again. Credit lines are revolving accounts, much like credit cards. Contrast other forms of financing like installment loans. In many cases, lines of credit are unsecured, much like credit cards are. There are some credit lines which are secured and therefore easier to qualify for. Credit lines are the most commonly requested loan type within the business world. Although they are very popular, true credit lines are rare and hard to find. Many are also very tough to qualify as they require good credit, good time in business, and good financials. What are 0% unsecured credit lines? You may have seen ads for 0% credit lines for $50,000, $250,000 or more. A 0% program is ideal for startup companies, high-risk industries, and those who don't have or want to provide proof of cash flow or collateral. Hence, unlike asset-based lending, you don't need to show or provide assets as collateral for approval. And unlike cash advances, you don't need to be in business 6 to 12 months or have consistent cash flow for approval. Here are some 0% unsecured credit line benefits. You only pay on what you owe, not like a loan. Hence, if you are approved for $100,000, you won't make payments on $100,000. You only make payments on the balance you owe. If you charged $4,000 on the account, you only need to make payments on that $4,000. And during the 0% interest period, you don't pay interest. It is possible to get cards that only report to business credit reporting agencies, not the consumer agencies. You can use this credit even with high utilization, with no adverse impact on your consumer credit. This is important because utilization is 30% of the consumer FICO score. When you use more than 30% of your limit on an account which reports to consumer CRAs, you can really lower your consumer scores. Often when you apply for consumer credit, there is an inquiry on your consumer report. When other lenders see this, they won't approve you for more credit, as they don't know how much other new credit you have recently obtained. Hence, they only approve you if you have less than 2 inquiries on your report within the last 12 months. More will get you declined. The 0% rate is an obvious benefit, but it's only available for a limited time. Even if the lender doesn't say the 0% rates will end, they will, because interest is how these companies make their money. Usually the 0% rate holds for 6 to 18 months and no more, although some sources will consider an extension if you request one. Let's look at credit lines versus credit cards. Credit cards are not the same as credit lines. A credit line is more like a debit card. Most credit lines don't offer 0% like many cards do, but credit lines do let you take cash out of the line at the same rate as the line is for, such as 8%. With credit cards, you can't take cash out on them without paying a hefty cash advance fee of usually 20% or higher. These are some of the main differences between credit cards and lines. Here is how a 0% credit program truly works. A lending source works on your behalf to secure credit cards for you. The company is not a lender or card issuer. Instead, they function as experts in obtaining credit cards, and work to apply to get you the most credit they can secure. Nearly always, their tactics to get you credit result in much more than you could get on your own. This is because they are going for multiple cards for you. The company you hire works to get you 5 to 8 cards, usually of the best and highest limit cards you can get. They apply for them all at once, so they can get you 5 to 8 cards where if you applied on your own, you'd only get 1 to 2 at the most. They can usually get you 5 times the amount of your current highest limit account. Contrast with your bank, which can only get you one of these types of account, which often doesn't report to the business credit reporting agencies. You can get 2 types of cards: personal cards, which report to the consumer credit reporting agencies, and business cards, which don't report to the consumer credit reporting agencies. Whether you get one or the other and how much money you get is all dependent on just one thing: your personal credit quality. The lender can also get you low introductory rates, typically 0% for 6 to 18 months. You then pay normal rates afterwards, usually 5 to 21% APR, with 20 to 25% APR for cash advances. And they'll also get you the best cards for points, meaning you get the best rewards. This credit is unsecured. It is obtained with no security, assets, or collateral. It is money that is lent where the lender has no collateral to collect in case of default. Because there's no collateral supplied, and they don't look or care about your cash flow either, all that matters is your personal credit. With a 650, you'll only get personal cards. With a 680 credit score, you'll get both business and personal credit cards. Multiple cards create competition, meaning you can get your limits raised typically within 6 months or fewer from initial approval. Approvals can go up to $150,000 per entity, such as a corporation. These business credit cards report only to the business credit reporting agencies. This is something most lenders don't offer or advertise. Not only will you get money, but you build your business credit also. Therefore, within 3 to 4 months, you can then use your newly established business credit to get even more money. Here are the qualification requirements. You need quality credit and no derogatory reporting. This means no bankruptcies, ever, on the report. However, you might get approved with bankruptcy if it is not on the report. Any judgments must be paid off. Any tax liens must be paid off. No credit counseling, no late payments in the last 12 months, no active outstanding collections and unpaid status. Less than $500 might be okay. There can be no foreclosures or late mortgage payments. There must be at least one bank card with a 3-year history or a $3,000 limit. If there is no car loan or mortgage, then they need 2 bank cards. Balance and limit ratios on existing revolving accounts matter. The lower the ratio, the higher approval amount will be. A 30% ratio is required. This looks at overall percentage and individual percentage on each account. For credit inquiries, this is a big factor trying into approval. More than 6 inquiries in 6 months is too much. Lenders do not want to see the person as applying for new credit, especially not for other revolving accounts. Here are some more 0% credit program details. You can use a credit partner for approval. This may be a partner, friend, or family member who wants to use their credit to help your business get money. For example, someone might want a piece of your company in exchange for allowing their credit and guarantee to be used to get this type of funding. If you use a partner as well as your credit, you can get even more money. You can also get an approval by using a guarantor. You can even use multiple guarantors in order to get even more money. See it from the credit source's perspective. They want to be sure they can get their investment back. A guarantor can make them more comfortable about giving you credit. Here is how much you'll get with a 0% credit program. The limits on existing accounts determine how much you'll be approved for. The limit is directly proportional to new approval limits, maybe slightly higher. A person needs higher limit cards for approval, typically over $5,000 is good. A person with $500 limits won't be approved for $5,000, maybe only $600. But a person with $10,000 limits might see approvals of $12,000. Approvals can be $50,000 or higher. More partners means more cash. You can usually get 5 times that of your highest limit account. Here are the fees for 0% credit programs. Most sources charge 9 to 12% success-based fees. You only pay the fee off what you secure. You pay an average of 10% on the amount you borrow. So that is $10,000 on $100,000 in financing. Know that all lenders on all loan programs charge fees. You'll easily pay 5% or higher even on an SBA loan. But this program, like most others, including SBA, roll in your fee, so you don't pay it up front. Once you get your cards, the fee is invoiced. This is one invoice per card. Beware sources demanding upfront payment and promising fast credit repair, as that gives them no incentive to get you the highest amounts. True credit repair takes time, usually many months to accomplish. Even then, to get over a 700 from a 500 starting point is very difficult. You must get good credit accounts to get good scores, which are needed for this program. So a real credit rebuilding process is not fast or easy. Plus, there are other programs you can get funding with easily that allow for credit issues without trying to fit into this program. Also, it's illegal to charge up front when credit repair is being provided according to the Credit Repair Organizations Act. You have rights when paying for credit. The service is fully performed. You have the right to be supplied a proper contract with specific statements. You have the right to be supplied 3 cancellation notices. Accurate info can't be disputed and untrue statements are prohibited. Here are even more 0% credit program details. Some sources may charge you for inquiry removal. Be careful. They often challenge accurate inquiries, but claiming they are fraud. This is illegal, and you can be on the hook for their actions. Some sources get high approvals quickly. They work with and know underwriters who will approve your application, and they apply at sources that will approve you. They even know these sources down to a regional level. Others get declines first, and then they have to negotiate to get you an initial approval. They do this by calling and pretending they are you. Even if they succeed, this process might take longer and can net you lower and fewer approvals. These accounts require a personal guarantee from you. These are not real business credit accounts because they require a personal guarantee and good credit for approval. And remember, you or your partner will be personally liable in case of default. Real business cards report to the business credit reporting agencies and will help you build real business credit. Let's now take a look at the 0% credit program process. Start the approval process by finding the best source. This is the source that will get you the most money the fastest and does not engage in shady practices. Once you find the best source, fill out their application. You are often contacted same day or within 24 hours. When contacted, explain what you are trying to accomplish and whether you have a credit partner. You will be asked for your login credentials for personal credit monitoring. Any service will work, but try to use one with FICO scores. Also, make sure you have access to all 3 reporting agency reports, TransUnion, Experian, and Equifax. If your monitoring service doesn't have all 3, it limits the extent of your approval. After reviewing your reports, many of the best sources provide an initial range of how much you might be approved for within 24 to 48 hours from starting the process. They do this on a consult call with you and will review all terms and details you should know. If you want to proceed, you sign their agreements. Once you sign, they usually start applying within 2 to 3 days and start getting initial approvals quickly. Some sources will get denials and must negotiate for approvals. This can take additional days or weeks. Once there are initial approvals, it usually takes 1 to 2 weeks to get your cards. Often you'll go from applying to funding in 3 weeks or fewer. As you get your cards, you'll receive invoices. Pay the invoice and then wait for additional cards. Good companies will provide their own unique login so you can track their progress live as it's happening as well. Hence, you'll know your cards are on their way. Plus, some companies will help you liquidate your cards once you pay your invoice. After you get your cards, most good sources will help you call to get your limits raised. They do this by using the other cards you were approved for to create competition. The source wants to give you higher limits than their competition. And after 6 months, you can then follow this same process with that source to get even more unsecured credit. Just be careful. Don't put too many inquiries on your report or it ruins your ability to get more credit. Now let's take a look at AR, or revenue-based credit lines. Their interest rates are 0.5 to 0.7%. You can get an immediate approval and fund the next day. This is an actual, real working capital credit line. The lender plugs directly into your bank account or your accounting software like QuickBooks for fast approvals. You can get approval for up to $100,000. You get 12 to 24 weeks to pay back whatever you use from this credit line. You are charged 0.5 to 0.7% in interest for every week the money is outstanding. This is equivalent to around $50 for every $1,000 borrowed. Typical initial approvals are under $50,000. To get up to $100,000, they typically want to see 2 years of tax returns as well. Once the tax returns are provided and perused, you typically get more money the next day. Let's take a look at an AR, or revenue-based credit line case study. A client in a high-risk industry came in. He got an immediate approval for $6,000. And then he provided his tax returns and was approved for $30,000. Rather than getting in on a program where he would have to pay 30%, we got him into this program and he only had to pay 0.5%. Here are the AR, or revenue-based credit line qualifications. There are 2 ways to qualify for this program. The first one is outstanding accounts receivable. These are businesses or individual customers that owe your company money but are paying you back the money they owe. This will show up in your accounting software or tax returns or bank account. The other way to qualify for this program is that you must have consistent revenue of $100,000 or more. This makes lenders more comfortable about loaning money to you. They are more confident that you have the ability to pay it back. Whether you qualify under outstanding accounts receivable or consistent revenue of $100,000 or more, you also must be in business for 1 year. Here are some AR, or revenue-based credit line details. If they are looking at your accounting software, they want to see accounts receivable or consistent revenue, or both. If they are looking into your bank account, then they want to see good bank account management. That means no overdrafts, no NSFs, non-sufficient funds. They want to see positive ending bank balances at the end of each month. There are no business credit score requirements. There are no consumer credit score requirements. There is no credit pull at all. Here are some other kinds of credit lines. The first one is an SBA CAP lines. The SBA says CAP lines is the umbrella program under which SBA helps business owners meet short-term and cyclical working capital needs. Loan amounts available up to $5 million. Loan qualification requirements are the same as with other SBA programs. Then there's an SBA Express. You can get access to a credit line for well-qualified borrowers. You can get approved for up to $350,000. Interest rates vary. The SBA lets banks charge as much as 6.5% over their base rate. Loans over $25,000 will require collateral. There are also alternative SBA credit lines. Private investors and alternative lenders also offer credit lines. They usually require good personal credit for approval. Unlike with SBA, many of them don't require good bank or business credit approval. Almost all of these types of programs require 2 years of tax returns. Tax returns must show a profit. There is also the cash flow financing credit line. Merchant cash advances are the most popular way to get financing, in large part due to the easy qualification process. Companies with $10,000 in revenue can get approved, with the business owner having scores as low as 500. Some sources now offer credit lines that go with their loans. And one final method is securities financing. You can get financing regardless of personal credit if you have some type of stocks or bonds. You can also get approved if you have someone wanting to use their stocks or bonds as collateral for your financing. Personal credit quality doesn't matter as there are no consumer credit requirements for approval. To sum up our look at too easy to qualify for unsecured credit lines exposed, remember, credit lines are reusable. You only pay interest on what you borrow. Unsecured means the credit grantor doesn't have a lien. A lending source works on your behalf to secure credit cards for you. Other types of credit lines can come from using collateral or working with an SBA. We can help. Contact us today to learn more about Too Easy to Qualify for Unsecured Credit Lines Exposed.